This video is a clear and simple strategy to take advantage of the next crypto bull market. When Bitcoin starts to move and go through its expansion phase, there is a lot of opportunity. So let's learn how to actually take advantage of that, how to set things up properly so that we can make very good investment gains through a crypto cycle. Timestamps for everything and all of the other resources I talk about linked down below. The first step is to make sure you're using a crypto exchange that you trust. Go to DeFi Llama and then go down to transparency. This page shows us all of the exchanges that do proof of reserves. This is where they cryptographically prove that they are holding client assets in wallets that they own. So this proves that they're not doing an FTX and stealing everyone's money and they haven't got any of it left. Right? So the exchange can still go bankrupt as a business, but if they've got your crypto, you'll get a recovery. The other option, of course, is just to withdraw your crypto into self-custody on a hardware wallet like Ledger, Trezor, or some others. Then you have full control over it and there's no counterparty risk. There are pros and cons to every method, but just make sure, number one, that you're putting money onto an exchange that is in business and is trustworthy. I'll leave some links below to the ones I use and have used for a very long time throughout cycles. They might have deposit and trading bonuses depending where you live as well, so you can check the details below. Let's start with comparing Bitcoin and altcoins and what we're actually doing right here in order to make money through one expansion phase and one cycle. These are the broad categories for this video. There are many different categories like DeFi, GameFi, SocialFi, other sorts of categories. That's kind of irrelevant from an investment standpoint. What we're really looking to do is to trade broad categories of coins that have specific amounts of risk and volatility and return to the, hopefully to the upside, but many will be to the downside. Let's make no mistake though, what we're trading is the Bitcoin cycle. The Bitcoin cycle rules all, and the crypto cycle cannot move outside of the Bitcoin cycle. It's all one thing. It's the macro cycle, Bitcoin cycle, crypto cycle. They are all intertwined. And so I'll go through later on the video how they're intertwined, how they move, and then why people try to play this with riskier assets for higher potential returns. We are looking at the Bitcoin cycle though. So you have Bitcoin and then you have other coins that we may want to invest in. So one category is BTC. The other category I've got for this video is real altcoins. What I mean by that is not altcoins that just will be successful over time, but ones in a cycle that have a narrative of having an actual real use case. So we can see there are many like this, right? So I've categorized Ethereum, BNB, Solana, Cardano, Tron, Polygon, Avalanche, Chainlink, right? These are coins where their teams are actually serious about saying we are doing something useful and important and we have a real use case. And so that's a type of coin, right? And so those narratives can pop off based on certain things. For example, upgrades like Solana is introducing a new validator client. That's something that people can trade. Maybe Cardano has DeFi that is launching and reaches a certain TVL. That is something people can trade. BNB launches a new blockchain, on Ethereum and launches applications. That's real and some people can trade that. Polygon has a bunch of exchanges that are now using its technology to produce layer 2 networks on Ethereum. Real use case, that's a narrative around that. That's the narrative that people trade, and you want to trade around those narratives in an expansion phase because they may give you higher returns. Then you have coins that just don't really have any real narrative apart from just being a speculation, right? So meme coins, other things, they don't really do anything apart from some, faint hope that they're going to go up in value. These things, ironically, during very, very bullish phases where money is being made, also can go up. Now, ones that went up last cycle usually don't go up in the following cycle. There are new coins that come in. There are new meme coins that are created, different type of narrative, a different type of meme that's popular at that time. But as we can see, we're moving up the risk curve, right? So Bitcoin has its cycle. It's pretty bedded in right now. And then we go up in risk, right, in this direction. So you can just use this very broadly as saying, how much risk do I want to take in a cycle? If I know Bitcoin is going up 3 to 5x, then how much do I want to allocate towards higher volatility with higher risk, because not all of these are going to do well and outperform. Some are going to outperform others, but you can have baskets. You have baskets of risk. So in an expansion phase, the only thing to think about is the baskets of risk that you want to take, and then it becomes simple. Then we get into high beta. Really what we're doing with a Bitcoin cycle is simply trading the Bitcoin cycle with extra risk if you want to get involved with all this stuff. Because what you're trying to do is outperform BTC in smaller coins. What is high beta? High beta are coins that are much smaller, but have an association with something much bigger that is moving in a bullish style. Now, that can be Bitcoin as the premier asset, and then Ethereum and other large alts that move with that, because Bitcoin drags them into bull cycles as well, and then they may outperform. But it also works, for example, with ecosystem coins. So on Ethereum, you have DeFi coins. You have Uniswap or Aave, and then you have a bunch of layer 2 networks like Optimism, Arbitrum, Base, and then you have applications built on those networks like, Uniswap or Friendtech or the other ones, right? And so all of these are extremely risky and volatile, but have a correlation with the less risky asset. This is all on a scale. Are these not risky? These are risky. Everything's risky, but everything's relative. So we're moving up the risk chain right here. So you're getting into like ecosystem coins, DeFi coins, SocialFi coins, meme coins on certain specific chains. So this is extremely high risk, and you have to know that an 80 to 90% chance of this, performing in a cycle and then going down and not coming back up. This is, of course, much lower risk and lower potential volatility. So everyone can have baskets of risk that they want to take specifically in their strategy. We'll look at the Bitcoin cycle in a second, because that's going to tell us exactly when to take risk and when to offload our positions. But firstly, I want to talk about fundamentals versus narrative. During a bull cycle, during an expansion phase where Bitcoin is going up in value and dragging many other coins with it, there is rampant speculation and narratives filled out into the market. These have nothing to do with the fundamental value or use case or potential of a blockchain. Now, there are two types of trading. You either trade narratives throughout a cycle and just get into some risk, or you actually say, I'm just going to invest in things that I think will be here throughout 5 or 10 years if you're a longer term investor. There's two different strategies. They can work for different types of people. If you go to Token Terminal, this is fundamental data for crypto, and it's going to show you how many users there are on a blockchain and how active it is. So you can have a look at this, and what we can see is that fundamentals are miles away from the valuations of these chains. So for example, you have Ethereum here. Over the last 30 days, it made $166 million as a blockchain. And a lot of that value goes back to people who own Ethereum. It's worth 200 billion, but at least it's making money, and so there's some fundamental value there, right? And it shows that this network is growing over time and actually producing revenue for people that own the token. Bitcoin doesn't produce revenue, of course, but it's wildly different. Bitcoin is a unique asset with its proof of work network and the way that it's set up. But if you look at other assets, these aren't money, right? These are not money. These are just application chains or chains that actually just have one simple business. And so the reality is these assets have to make money and return that to investors in order to have some sort of value long term. But the fundamentals can be wildly different to where the token actually trades at. Example of this is Solana, which over the last 30 days made $2 million, but the chain is worth around $30 billion as of right now. So you've got a $30 billion valuation with an asset that actually trades and earns $2 million a month. So those valuations are not in any relation to each other, right? So there is really no fundamental value in most of crypto. There is just hope that some people may use it. And the way that the price goes up of those tokens is because the token is essentially completely owned by the very small amount of holders. And so the price can go up a lot within a cycle because you get a very small amount of buyers that come in, price goes up, but there actually aren't any sellers because the tokens are either locked up or the foundation doesn't sell them or can't sell them quick enough And so you get these huge price discrepancies and volatility. That's something that you can take advantage of in a bull cycle. But always know that if you're trading a coin that isn't really very large and actually fundamentally valuable, then it can drop very, very quickly just as it goes up. 50% down, 80% down, 99% down, because the reality is there's no fundamental value there. So know what you're getting into with altcoins, and even Bitcoin as well can go down 70% in a bear market, right? So there is huge volatility here. Fundamental value is completely detached from valuations. And that's just something you have to live with. If you want to take advantage of it, you have to make sure that you get in and out, because you don't want to be holding the bag when we turn into a bear market. So how do we time the Bitcoin cycle in order to take advantage of the expansions? And we can actually take advantage of that with, many different types of assets. We can take all the risk that we want. The Bitcoin cycle is really the macroeconomic cycle. It coincides almost perfectly. So you have the Bitcoin cycle, macro, you have debt refinancing cycles, the business cycle. It all seems to coincide within this 3 to 5 year window. And the Bitcoin cycle is every 4 years. So within that cycle, there are expansion phases and there are drawdowns. Now for Bitcoin, it's very, very clear fundamentally that the Bitcoin network is growing over time. There are more people using it. There are more active addresses. There are larger institutions each and every cycle that come in. So that network is growing fundamentally. Now from there, now that we know that, we can just take advantage of these short-term 4-year price cycles. And when do you take risk? You take risk when risk is cheap. Paying a lot of money for something is never a good idea. So when prices are high during the peak of a cycle, it's the worst time to take risk. That's the most expensive time to pay for risk. And that is when you do not buy. Now, you look to actually sell and take profits during those. During a drawdown, that is where you take risk because risk is cheap. So this is when you start to take risk. Now, of course, as we're coming out of that as well, there is a opportunity to take risk here as well. Just the top of each cycle is clearly not the time to be taking risk, and is actually the time to be maybe taking profits. When exactly is that? This is the halving right here. So we know that the halving is in April 2024, around there. So from that date, you can see what happens after each halving. You really get a 300 to 500 day window where the price expands into a new all-time high. That is when to wait and take profits. So after the halving in April 24, you're going to get an expansion between 2 to 500 days after. So let's call it 12 months to 18 months, something like that, is usually the peak of the Bitcoin bull market. As Bitcoin draws down, it's very, very unlikely that many altcoins will keep going up during that time. So if you're taking risk, you want to be in before that. The best time, as you can see, is before the halving. It seems like there's a drawdown around 800 to 1,000 days after each halving. That is when you get the bear market bottom. Bitcoin starts to bottom out, and so altcoins will potentially do that as well. In this cycle, in blue down here, that time has passed and gone. That was the FTX explosion, Luna, and everything else, right? This period between 5 to 1,000 days right here, this was the bottom of this bear market and the bottom of all previous cycles. You can see that here, the average of them. So this is the best time to take risk. This is when you're paying the lowest price for risk. And as you can see, we're climbing out now, coming into the next halving in April 24. There is still time, but time is running out to take risk in BTC, given that after the halving, it usually reacts to a new all-time high. This is not just Bitcoin. This is the macro cycle as well, and the economic cycle just happens to coincide every 4 years or so. So in terms of timing, it's, let's say 5 months or so that we still have to actually take risk and take longs, and then wait for the expansion phase another 12 months after that. Now, there are opportunities in between there. There are drawdowns and everything like that, and specific coins pump and dump at different times. This is a broad general cycle right here. So the drawdown occurs. That's the best time to take risk. You get this slow recovery phase, And then after the halving, it's usually maybe a few months before it starts to react and really go to the upside. So have that in the back of your mind as a time rather than price. We don't know what the price will be, but this cycle is based on time and the effects of the macro and everything like that. So we are coming into that right now, as you can see. So it's going to be volatile, but that is essentially, what we're looking at. Now, you can also go to look into Bitcoin, which is a free website. Again, a link below. Many other websites do this, which is Onchain Data. If you don't know about Onchain Data, then check out the Crypto Investor course. So this is a course with over 300 videos now. I update it for free for existing users. So check the course, I'll link it below. But it's it's a starter guide for investors with crypto. I have 15 years experience in investing. I was a professional back in the day. I was fully qualified investment advisor. I've put that investment stuff towards crypto. So if you want to know about crypto, tokenomics, how to do on-chain data, how to analyze this stuff, plus my research down here, which is for free for existing users. You can see that here. Every few months, I just update it with latest research, latest on-chain, how things are looking in the macro, and my portfolio, all my trades are all in there. So if you want to check it out, just check the link below. But I'll go through that in this video in terms of on-chain data. On-chain data is amazing because it gives us a real look at where flows are, and it gives us a look at the cycles. Very simply, MVRVZ, it gives us a score of the realized cap of Bitcoin. When Bitcoin is massively overextended, MVRV is very, very high. When Bitcoin is drawn down to the downside and it's extended to the downside, MVRV goes way down. That shows us cycles. So that's the orange here. If we just take out this, right, what you would say is, well, buy when risk is cheap and sell when risk is expensive. That's all we want to do. So you buy in the green zone, you buy when risk is cheap, you sell when it's expensive, buy cheap, sell expensive, buy cheap, sell expensive, buy cheap. You can see what we're doing in this cycle. We are down in the buy zone here and we're climbing out of it just like every previous cycle. Given that Bitcoin is growing as a network, we would expect this to then have a reflection to the upside as well. So if you put the market cap back, you can see that MVRV peaks at the top of every bull market, right? One here, two, this one, MVRV peaks and goes into the red zone. So that shows us cycles. So in terms of taking risk, if you want to say, when do I take risk? When do I go in? It's not about price. It's about time in the cycle and where the cycle is. We're still towards the bottom end of a cycle as of this video, but you should use this as your timing for taking risk. Risk, okay to buy when it's cheap. As we get up, you want to start thinking, do I really want to be taking more risk? What is the risk return here? Because as prices get way, way overdone and the cycle gets very, very late, that's the worst time to be taking risk, right? You really don't want to be there, because if you're taking risk in stuff, especially if you don't believe in it and it's way overpriced in terms of fundamental value, the next part of the cycle, when things get way overdone, is not to the upside. There are always cycles. Even the S&P went down like 30%, right, last year during a bear market. Facebook, when it changed to Meta, went down 50%. One of the biggest stocks in the world. So you can get drawdowns. So what I'm saying is, during the peak of a bull market, valuations get extended, money's very loose. You really don't want to be taking risk here. So use these cycle and on-chain data to really look at when you want to be taking risk and not. Everything is the same thing, really, which is just these cycles of growth. So you can see realized cap hodl waves. When the dark red expands, you can see these expansions. These are the massive bull market expansions, right? This means that new money is coming in. As of making this video, we're still in the kind of bear market recovery phase. So again, when risk is cheap, that's when you want to buy it, assuming that you want to take a certain amount of risk. When risk is expensive, you should be looking to offload and not be going very, very long in very risky stuff. Because a small change in how this market moves, the riskiest stuff moves the most, and so you're going to get caught out. So we want to take the most risk when it's cheap and then wait. During the expansion phase, there are many opportunities. You just don't want to get caught in at the top of a phase. Again, we can use the 200-week moving average. So it's a moving average of the price of Bitcoin over 200 weeks. That plots a very smooth line, which you can see down here. Whenever Bitcoin draws into this line, risk is cheap. the Bitcoin price is cheap in relation to its growth. So a bear market here is when you take risk. Then you take risk. You can take risk for a while, especially in Bitcoin and altcoins. During this phase, when we have these big expansions where everyone says everything's going up, that's really not the time to take risk. We can see we're coming out of this phase again, going into potentially some sort of expansion phase again. Next, I want to talk about beta or beta, however you want to call it. What is this? This is a concept that measures the expected move in an asset relative to movements in the overall market. When you're trading altcoins, when you're trading smaller cap stuff, what the investor is actually trying to do is gain exposure to something that has correlation to Bitcoin. So when Bitcoin moves up 1%, how much does Ethereum move? How much does Solana move? How much does meme coin move? Because if Bitcoin is up 100%, these things have a correlation or a beta to Bitcoin. And so, how much is that? And is it worth it going out on the risk curve or not? So what we can see here is this is research I did for the Crypto Investor course. So I actually put this down in May this year. So you can see the Discord groups here. I just sent this as a bit of research. So you can screenshot this and read this, but I'm just going to very quickly go through here. So from the start of the 2019-20 bull market, right? So kind of, at the start or midway through that, if you put money in, and what was it 3 years later after the bull market and during kind of the drawdown? Bitcoin went 3.27x. The top 10 coins, including Bitcoin, went 4.3x. So they did outperform Bitcoin only. You got better performance from buying Bitcoin plus top 10. The top 10 coins, excluding Bitcoin, went up 4.1x. So they still outperformed Bitcoin. And then the top 10 to 30, so under top 10, those 20 coins went up 3.9x. They outperformed Bitcoin. So Bitcoin was actually underperforming versus these coins. So that's that. So if you do want to take extra risk, there might be some extra returns for you, but there is a lot of hassle here. You can see that 40% of the top 10 coins lost money. Not even lost money in Bitcoin terms, they went down in dollar terms. So when you're buying those 10 coins, 4 of them are going to go down in value, just straight up. The others underperformed Bitcoin, but there were 2 coins, ETH and BNB, that outperformed. So of those 10 coins, only 2 or 20% of them were actually worth investing in. So that shows you that either you are extremely good at research / lucky, or you have to just kind of buy these 10 coins knowing that 80% of them are garbage. Of the top 10 to 30, 55%, 55% of them went down in dollar terms. 5 outperformed Bitcoin, and Doge and ADA were essentially the ones that brought up the entire stack to actually outperform. So what this shows is, with altcoins, you are really, you're in the Wild West, and you do have to diversify if you don't think that you are able to spot the 2 coins, the 10 to 20% of coins that are actually going to outperform. If you can't do that and you want to diversify a little bit, it has to be 10, 15 coins, knowing that, 60% are just 60% going to lose money, more or less, and most of them are underperform BTC. So this is what we're playing with. Now, this is from the mid bull market to a bear market. That's very different within a bull market. Like I said, within a bull market, maybe, the more are going to outperform BTC. During the bear market, they really fall off a lot. But it shows what we're dealing with and shows the type of diversification that you need if you're going to be playing around in altcoins. This is a sample crypto portfolio or crypto strategy that you'll see a lot around. I'm sure many other people will show you something like this with a low risk portfolio, which is going to have either Bitcoin or a mix of Bitcoin and ETH. Why low risk? Still extremely volatile in price, but Bitcoin has been around 15 years. It's very clear that this asset is demanded by a set of people, and those set of people are growing over time. So in terms of low risk, it's still very volatile. ETH has been around long enough where it's, been through a couple of cycles and seems to, have a use case there as well. Now, that doesn't mean you still can't lose money. It might underperform. We just don't know, right? But in terms of crypto, that's what people will put as low risk in ETH. In terms of medium risk, an amount in Bitcoin and ETH that is less. Top 10 basket which would be some X% of the portfolio, like 20%, and then 10 to 30 down here would be 10%. Now remember, these actually did outperform Bitcoin last cycle. And so, that is potentially somewhere where you'd want to put money. But with that comes a lot of extra hassle. Not only do you have to buy potentially 20 coins, which is a nightmare, right? So how do you do that? Where are you going to buy them? Are you going to keep them all on your exchange? Because are you going to take these out onto the blockchain? Most of these coins are built on Ethereum, where during a bull cycle, the blockchain fees are like $20 or higher. So you're going to withdraw all of them into an ETH wallet. From there, how are you going to sell them? You're going to go to a DEX and you're going to pay another $100 to actually get the asset signed into the DEX and then trade it, or are you going to send it back to the exchange? It's a nightmare. It's an absolute mess. If you're looking for maybe a slight outperformance over BTC or ETH, maybe that isn't something that you'd want to consider, right? Because we've seen what the data shows is that potentially not massive outperformance here in the big scheme of things. It depends, obviously, which assets that you buy. So that's an issue. Now with high risk, people are saying just go down in BTC and ETH terms again. But essentially what we're looking at is spreading a ton of assets over a lot of different altcoins, which is a nightmare to manage. And even if one does really, really well, a lot are not. And I put gems here. So these are those, very, very speculative ecosystem coins, the highest beta, the highest reaction. So, you've got Bitcoin and then smart contract chains and then layer 2s and then apps built on layer 2s. There are going to be some things that go off and do very, very well and be the stars of the cycle. Potentially you may own it, but you may have to own 20 other coins as well, because we don't know which one is going to pop off. This is really the only way people put together public market portfolios in crypto. If you're not a VC, then you won't be getting seed rounds and Series A rounds where you're getting tokens basically for free. You're going out into the public markets. And so you can outperform Bitcoin. It's possible with the top 10, 20, 30 coins, or looking up some smaller coins or coins that are newly released. But you have to go through a lot of garbage to get that outperformance. If you're slightly better at research, you can maybe push up this percentage a little bit, but it takes a lot of work. And, there is just something very simple, which is Bitcoin, that maybe is a much easier bet for a lot of people. And so another way of doing this is actually what a lot of people do is trade with a bit of leverage. I can't recommend leverage, but it is something that a lot of traders do. So I'll explain that here. The way that leverage works is that people essentially choose to trade in, crypto futures where you can take leverage. That means that you make a trade and you get a 2x, 3x, 4x leverage trade on what you put in. So instead of buying altcoins and having to buy 10, 20, 30 assets and manage all of that to try and get some outperformance, what people can do is just simply leverage the price of BTC. So how they would do it on a leverage exchange, either on a centralized exchange or, decentralized exchanges do this now, is you trade with leverage. So you can actually trade, you can see here, with an amount of leverage. Let's just do 2x as an example. Press confirm. You can now have a short-term trade. Crypto futures are for short-term trading, not long-term, because there are costs involved, funding costs and things like that. But essentially, you now trade with, let's say, $1,000. You can leverage that 2x, meaning your $1,000 trade that you put in is worth $2,000 in the market. Now, essentially what you're doing is increasing your beta or beta to Bitcoin. For every 1% that Bitcoin moves, your position moves 2%. If you do 3x leverage, for every 1% Bitcoin moves, your position moves 3% to the upside and to the downside. This is a way of playing the Bitcoin cycle, which is much more predictable with something where you're increasing your beta to the upside during the expansion phase. And what's the downside of leverage? Number one, you have to put your assets on a centralized exchange, which you may not want to do. The second thing is you can get liquidated because you're essentially borrowing money from the market here. The way it works is that with leverage, the money that you put into the system is there to pay for any potential losses. So they say, sure, 2x leverage, we'll open a $2,000 trade for you. If the price moves down 50%, your $1,000 is now worthless because your trade was 2,000, 50% of 2,000 is 1,000. Your initial investment is gone. So the downside of leverage is that with a very highly volatile asset class like Bitcoin and crypto, things can move down a lot. And during cycles, you may get a 20 to 50% drawdown. It's very possible. So if you use 2x leverage, your liquidation is at 50%. If you use 3x leverage, a 33% move down in the price of the asset you're trading wipes you out. If you're using 4x, just a 25% move. And with 5x, if a 20% move to the downside occurs, you get wiped out. So you can see your higher beta, right? For every 1%, you can have your price move a certain percent, but the risk is there. Now, there are many ways to manage this. For example, people will put an amount in. Let's say you put, you have your 90% allocation to Bitcoin and ETH and, 2 other altcoins, but you want some extra volatility when you think prices are rising. You go and take leverage. You don't overdo it. So maybe only 5% of your stack or 10% of your stack is in a leverage position because you're thinking we're in a bull market and you want to get higher beta, right? You want to get that risk going to the upside. So 10% of your stack is in this trade rather than looking at a bunch of other altcoins and saying, oh man, I have to buy another 5 and 7 coins here. And God, what's going to happen with this one? And is the team going to sell the coin and what's happening? You can just say, it's just based on price and I take extra risk. So 10% of my portfolio goes towards a leveraged trade. Now, during that, right, if the price moves down and comes to my liquidation, if it's maybe 6 weeks after or 8 weeks after, you can put more equity into the trade. So what you can do is actually just put more dollars into the trade to move the leverage down and just start paying off the leverage. And so that reduces leverage and gives you more breathing room in that trade. Right, and so it's a way of actually getting more Bitcoin or whatever crypto you want to trade now and then paying it down if managed well. Now, I can't recommend leverage because I've seen it wreck so many people and people use way too much leverage, right? They use 10x leverage, and then a small move wipes them out. They were directionally correct in a trade and the volatility wrecked them and lost all their money and then the trade was correct after. So there is massive risk with leverage. Of course, risk and reward go hand in hand. So I can't recommend it for normal people. I think if you've just got a normal, job and a family and you're just looking to invest, this type of thing is much more for experienced people that can manage that risk. But it is a strategy people use. Either leverage directly with the price or you're trying to leverage price movements with altcoins. Let's be fair, most of these altcoins are going to last one cycle or so, and you're just taking extra risk and leverage with them as well. So it's about timing the cycle and timing the beta that you have to that cycle and knowing that fundamentals are usually way far away from the actual price of these things. So you have to know exactly your strategy before actually pressing the buy button at all. If you want more specific guides on actually trading, using exchanges, how to withdraw crypto to your own wallets, I'll leave all of those videos down below. The Crypto Investor course is 300 videos, which is step-by-step on all of this as well. So you can check that out if you want. I'm James, it's MindZG. Cheers for watching, and I'll see you in the next one.